You have definitely heard of the famous MACD indicator. Almost everyone has used it at least once or twice. But what if I told you there is an even better version? An indicator that automatically adapts to the current trend, so you don't have to keep changing the settings all the time. As a result, it can spot high probability reversal entries with impressive win rates. With this indicator, you'll be able to spot when an uptrend is running out of momentum, giving you potential short opportunities, or when a downtrend is nearing its end, helping you identify bullish trading setups. To add this unique indicator to your TradingView chart, simply open the Indicators tab and search for the Napoli MACD and Stock by Lazy Bear. I'm going to show you two ways you can use this indicator in your daily trading. I'll break down both strategies in depth so you fully understand the concept, and by the end, you'll see why this indicator outperforms so many others out there. But before we get into that, let's cover a few basics. When the MACD histogram is green, you guessed it, it indicates the market has bullish momentum, and the overall trend in that area is likely bullish. When the histograms turn red, they indicate bearish momentum, suggesting the overall trend in that area is likely bearish. The MACD and stochastic indicator helps identify potential reversals using a concept known as divergence. Divergence occurs when the price and the indicator start telling two different stories, making it a common sign of trend exhaustion or a possible reversal. As you can see on this chart, the candles have reached a key level and formed a major low. In situations like this, traders naturally start looking for reversal opportunities. The price has made a lower low, which normally confirms the downtrend. But if you look at the indicator, it is telling a different story by forming a higher low. This contradiction between the price and the indicator implies that the momentum is fading and something could be about to happen, either a period of ranging market or a beginning of a new uptrend. This is what we call divergence. It doesn't tell you exactly how far the price will move or when the reversal will begin, but it does signal that a reversal may be approaching, even if it's only a small one. So from somewhere around that low, there is a potential long trading opportunity, and as you can see in this example, it played out very well, offering a 4-to-1 risk-to-reward ratio. The opposite happens when the price moves higher and forms a major high during an uptrend. This is where many traders begin looking for a reversal opportunity, especially if the uptrend has been strong, as it could run out of momentum at any time. The price has made a higher high, which normally confirms that there is an uptrend, but the indicator is telling a different story. The green MACD histograms associated with the uptrend are forming lower highs. This implies that bullish momentum is weakening and that a reversal may be approaching. This concept is called divergence, a contradiction between the price and the indicator. And let me remind you once again, divergence doesn't tell you how far the price will fall or the exact point where the reversal will begin. It's simply a sign that the current trend is losing momentum and that a reversal could just be around the corner. Now that we know what divergence is, let me show you how to turn it into potential trading entries. Because in trading, timing and positioning are everything, and we need to be extra careful. And with some simple price action techniques, we can identify high-quality entry points. In this chart, we're looking at Ethereum on 1-hour time frame, and as you can see, the price is making higher highs, while the MACD indicator is making lower highs. That means divergence is present. Now that we know a reversal could happen at any moment, we need to prepare for a potential entry. I can draw a support zone based on the previous base. A breakout below that support zone can be a sign of change of character, suggesting that momentum is starting to shift. In general, support and resistance breakouts can provide solid trading entries. Eventually, the price breaks below the support zone. Any pullback to that previously broken level can provide a potential short entry. This particular setup turned out to be a successful trade, but if you look a little closer, the market actually offered a second opportunity. Notice how the price formed a major low at the end of the move with a morning star candlestick pattern, which is a well-known bullish reversal signal. And as you can see, price is making higher lows in that area, while the indicator continues making lower lows. Once again, we have divergence. For a potential entry, you could use the pivot created by this minor swing low. This is a live Ethereum trade on the 1-hour time frame, so you can check the chart later on and see how far the price moved. At the very least, the expectation would be the price to retest the previous support zone, which is now acting as a resistance. Let me show you one unique feature of this MACD indicator that can actually be applied to a normal MACD as well, something I personally haven't seen anybody talk about. Instead of looking for chart patterns on the price itself, we're going to look for reversal patterns on the MACD histograms and potentially trade them. Take a look at these green histograms. What do you notice? The histograms move higher, pull back toward the MACD midline, and then push higher again, creating two peaks. It just looks like an ordinary double top chart pattern. Price action traders have been using patterns just like this for years. From what I've observed, the same patterns can form on the MACD histograms and provide potential reversal signals. In this example, I can draw a support zone beneath the ranging market. With both the double top and the divergence present, I can start looking for a potential reversal trade. The breakout below that zone then provides the entry. Now let's look at one final example to bring everything together. In this chart, the red histograms have formed a double bottom, which is a classic sign of a potential reversal. It implies that the sellers are becoming exhausted and are no longer able to push the price to new lows. This setup becomes even stronger when it's combined with divergence, but even without divergence, a double bottom itself remains a valid reversal signal. On the price chart, I can draw a trend line along this downtrend. Once the histograms turn green and the candles break above the trend line, that can provide a potential long entry. So go ahead and test this indicator for yourself and let me know your experience in the comments below. I'd love to hear how it performs on your chart and whether it fits your trading style. But before you go, I have to announce that I'm not a financial advisor and this is not a financial advice. All content, information, and opinions shared in this video are for educational and informational purposes only. Trading involves risk. Consult a professional before taking financial decisions.